Today's discussion will be something slightly different, particularly around how you can think about venture capital and private equity and how these two organizational methods are the peak of Faustian capitalism. And when we start talking about capitalism, I want you to kind of forget the political concept of capitalism as this weapon or arm of a certain type of Keynesian or communist government. If you step back and just realize that capitalism is merely the economic version of assigning capital to certain processes or organizations in a way that is the most efficient. There's no moral, ethical underpinnings to it. There's association. The materialists, and this is the Marxist, but the materialist understanding of economics is this labor versus the capitalist is nonsensical. We won't deal with that here, but it's in relation to a bad understanding of economics in general, but capitalism in particular. And capitalism, like I say, has no ethical considerations. It is just the way that we can allocate capital from one person who has it to another person or organization who needs it in a way that we want to develop a opportunity or something like that where we can earn more profit. So the way that the profit is earned might have ethical complications, but the capital direction and the disbursement of capital is just the reflection of assignment of an efficient market. Anyway, with that understanding forming the basis of this conversation, what I will do is walk you kind of through this history of industrialists and capitalism and how we go from having a classical financial system, which is based a lot around debt and usury and large financial institutions more or less bankrolling bigger projects like wars and infrastructure, to a much more, you'd almost call it democratic level of financial instruments which serve multitude of purposes and can enable more people to improve their economic standing. So classically we have the, you might call it tycoon or magnate. This is a 19th century development when the real industrial revolution kicked off, and we went from an economy that was dictated quite heavily by agrarian and singularly produced goods. Adam Smith talks a lot about this in his works on capitalism, but the wealth of nations. But he is also identifying how labor interacts with specific materials to produce goods, and that the scale process on this influences our understanding of costs, and then costs and prices interact in a way that doesn't necessarily reflect labor per se and expertise, but more rarity and supply and demand. So this is a really important distinction that has been made, where we go from this, and particularly in barter economies and trade economies, to a fiat economy where there is a fungible token which you can then exchange for goods. Now, developing an economy that's more sophisticated requires financial instruments to reflect that, but then also it enables businesses to become more complex. Thus we get something like the stock market, whereby anybody and everyone who has capital can allocate it as they wish to public companies in return for a future promise of potential earnings. So there's speculation involved, of course, but it is a somewhat parallel function to debt. So debt is still risky, but less in the way that there's a promise around profit share than there is just a repayment schedule around the debt itself. And whether that's a pay-in-kind loan or it's a bullet loan, there's different mechanisms around how to pay, and this develops into something like a junk bond, which is a really high interest rate bond on a very low security, high risk, low secured loan. And then developing into what we had as mortgage-backed securities and these package loans, which caused the 2008 financial crisis due to the inability to risk calculate these ones correctly. But however, so there are a lot more different financial instruments, that is to say, over the last 200 years that have been developed to reflect a more complex and ever-burgeoning economy. The men who stepped up to embrace and utilize these things and grow these industries as I said, are known as tycoons or magnates, and these great men of economic history, you might call them, have been able to dominate and project their will in a way that hitherto had not been seen before. So particularly the great history of man was a warrior or a general, and now we can also see these robber barons and financial magnates step into the fore and dominate in a different facet. In classical history, there have been very, very rich people, even in the West, with Fugger and the Medicis, etc. But those were always very simple and basic constructions on financial networks. They weren't complex, industrious organizations where there was direct lines to innovation and technology in the same way. And so this intersection of capital and technology is more or less where we start to see these prolific growth trajectories in businesses, and then the men who own these businesses. So I have here, I think, a few things to get us started. I want to say that there is a hybridized version of this in Cecil Rhodes, and he, as you can see here in this funny cartoon, he is basically the bridge from one foot, or the one end of Africa to the other, because his ability to, and this came down to his construction of the De Beers company in mining, but his ability to formulate business into what was basically a state and thus form what is South Africa and Rhodesia, and still have the ability to be both a statesman almost and a business leader, because of the way he was able to channel this Faustian will to dominate, which is super interesting. And I think Spengler himself calls him one of the first men of the age when it comes to an understanding of how economics now influences our understanding of politics, and why money politics was running its course through people and men like Cecil Rhodes. We're now entering the time of blood politics, which indicates a more deep and visceral reflection of politics now is about who's willing to ideologically follow a message and die for that message. But in contrast to that is obviously this money politics, which you can still feel the effects of, particularly in a country like America, which is predominated by money, and that backers and financial super PACs end up supporting a presidential candidate with promises behind closed doors, or even just lower level politicians like senators and congressmen with these promises, who will be reflected basically in the legislation that they get written for them. But the money started here, and so in the 19th century we had a denigrating pejorative term, or sobriquet for these men called us robber barons. So men like Andrew Carnegie, who was a famous steel guy, J.D. Rockefeller, and J.P. Morgan here. These are all men who, what came to be known as forming trusts, and a trust was just a monopoly in a way that tried to elide what the notion of a monopoly was in the governmental regulatory sense. J.P. Morgan himself was not necessarily a trust owner in the way that he worked just for his father's bank, Morgan and Co, I think at the time, where he was just financing a lot of these trusts. And because the stock market in early 20th century and late 19th century America was made up predominantly by natural minerals and oil and gas companies, but they're mostly railway companies. So railway companies have this long history of the American Stock Exchange, leading to a lot of boom and busts across the 19th century, because the speculative nature of railway companies allowed them to take on a lot of debt, and the debt didn't necessarily have a very well understood risk profile. Nevertheless, JP Morgan was mostly involved in almost every single formation of a trust in every type of industry in America, and America at the time had grown from being something like the 6th or 7th economy in the 19th century to being the #1 economy, with Germany quite closely mirroring a lot of their formations, with the UK dropping off because of the inability for the UK worker to, you could say, work hard, but have this spirit of innovation and industrial energy. Nevertheless, the formation of, and these are almost archetypal and mythologized businessmen by this stage, where they completely owned such an industry in such a way that their fortunes reflected what you might think that a titan of an industry would have. And so I think Andrew Carnegie and J.D. Rockefeller, obviously very well known for being extremely wealthy and having what would be the modern day equivalent of hundreds of billions of dollars in net worth, and how they structured their companies, because there was not as much, you might call it, politesse or decorum those days. So there was a lot of this almost backstabbing element and manipulation of markets to form trusts and businesses in such a way that would inhibit competition, and that there was buying of other railways, there was buying of other steel mills, of other oil derricks and refineries, because you obviously wanted to make sure that you had this monopoly which we could then raise prices on, and if you're raising prices then you can obviously see the benefits from that. Even in competitive states you could still run a company, and this was Andrew Carnegie's you might call it exceptionality or his edge, competitive advantage, was that he was able to produce steel for such a cheap price that he could undercut any market to the degree of putting others either out of business or making their businesses so woeful and cheap that he would just buy them. So you can see these business tactics have a lot to do with war in a very economic and almost in the intellectual sense, and how we can think about economics is just another extension of the Faustian need to project will and dominate. This continued obviously with many different types of businesses across the 20th century, and Henry Ford was quite a good example of building a business like this, where being so monomaniacal about having cheap and very efficient productive industrial capacity allows for the development of very many commoditized, in his case, cars, which could be sold with a known price, and thus fixing what would eventually be called vertical integration around what inputs for designing and building a car would be required. So Ford ended up even owning, say, rubber trees in Malaysia, so that he could import the rubber to make his tires. This full value chain is why you get businesses in America, in particularly Germany and also Japan, owning such a varied and myriad different types of businesses that you would think nowadays makes no sense. And this is to say, like, why would Cargill, who is ostensibly a grains and wheat producer or trader, own a lot of ships and boats? So these type of companies grow and develop into what we call multinationals today, with their fingers in all types of different pies. And this comes back, like I said, down to the way that businesses were structured around a dominating effect of, I want to be the monopoly in as many ways as possible in my niche, and that you could develop these niches like this. Modern day, you obviously have the same thing with companies like Google or Meta, where if the intention is to create a product that can dominate the space, then you can expand it globally and in a way that it prevents competition, particularly with the network effect. So if everyone is on one particular platform or service, then it's unlikely, if you want your friends or your businesses to use a different service, that it's compatible, and it's very difficult to wean people off of this notion. This is why you get companies like Apple, who have a whole network or constellation of products which all feed into the nucleus of one Apple ID or one Apple account. Excuse me. So there is two elements to this. There's the development of the behemoth or the juggernaut of business, and then there's also the man behind. And so if we look at the man behind, I think there's quite a good documentary called The Mayfair Set, which looks at the 70s and 80s in the UK around the development of businessmen as this new pioneering Viking type. And I think the documentary in particular tries to be obviously entertaining, but also painting a moral picture around this. But if we look at the character, well, the real life people, but the characters involved, for instance, Tiny Roland here, who was an African businessman, and he tried to buy Harrods unsuccessfully, but he was able to more or less be the twilight of the nabob. He was the man who would travel internationally with his various business interests in maybe not so stable African economies, and still be able to, and whether it was oil or minerals and precious gems, etc., his ability to harangue and set up businesses is super admirable, in the way that he was more or less a force of will when it came down to this business idea and what he viewed as the economic dominance and victory. So his, I think in particular, story and personality is one of those very strong Western types, where maybe not that many have known his name or familiar with him, but I think it's definitely, if you were interested in this sort of topic, then it's worth exploring more. And you can obviously see here also with the previous Americans, where it's a super impressive man who's able to go out and dominate, project his will economically in such a way, and how the interaction of that with what we can see today in a market formation akin to political and maybe more social ramifications from having a lot of money and trying to dominate certain parts of the socio-politic body. Well, maybe the presentation can kind of pivot here into a bit more modern, and how the translation of finance to businessman in technology, industrial captain of a technology company. And technology here is not necessarily IT and like software, but that is what it has grown to be, and I'll go through why. So Warren Buffett here is a classic example of financial minded, you might call it conquering, but his understanding of how investment works, to the degree that he was able to utilize existing businesses creating cash, particularly insurance businesses which have large cash piles, and dedicate that towards buying and owning several other companies, in a way that he's formed a conglomerate almost artificially. So he himself has never actually built anything. He never actually put his, dirtied his fingers with creation and IP creation or technology. But what he was able to do was see that finance could be set up as a tool in such a way that ownership is more almost important from a creative standpoint, or capital allocation is more important from a creative standpoint, than being the ideator and innovator and engineer. Now, it isn't necessarily the case that we should admonish him. I don't think he is morally corrupt or anything like that from his lack of venture experience. But what we should take him for is definitely someone who's this new type of businessman, where the prior assumption around what we constituted the very separate and differentiated banker, so a man who provided financing, who sits in a bank, and you go to him and you show him your business plan and say, can you loan me £1 million? And he would say yes or no, and then you would have this entire interaction. Then the bank would make money. You would ideally also be making money and be successful, and there'd be some relationship with the bank. Alternatively, Warren Buffett basically just bought businesses using cash and then existing cash flows to also lever on top of businesses, and then he IPO'd Berkshire Hathaway and was able to generate capital that way, which he would then use to buy further businesses, thus kind of snowballing his wealth. Along that way, you have to make good decisions. You can't buy trash companies. And he's a big proponent of what we call value investing, which maybe you can think of as super nice timing because of the way that information was not transferred efficiently during his rise to the top. Basically, if you're able to understand a business in a way and utilize data in ways that not many other people had opportunity to do, and that there was also just less capital flowing in the market in general at that time. So once again, not to take away much of his success, but there is a very strong conditional element to his success, and that he would not be able to replicate the same growth today, for instance. The same could obviously be said for other businessmen like Henry Ford, but Buffett's abilities to grow is basically what we would call this economic and financial genius, or which is a very stark contrast to the technology and the entrepreneurial genius, which is someone like, say, Elon Musk. And so Elon Musk is this very modern day Faustian man who has the intrepid spirit and entrepreneurial conditioning that's enabled him to start manifold successful businesses. Whether you admire him or you find him intolerable, and this can be both from his personality but also the way that he's gone about trying to engineer success for his businesses, is almost separate to the understanding that it takes quite a strong will and determination to go and create all these various businesses from ways that require him to be technical but also understand the process and operational side of a business. So he's not Warren Buffett out there throwing money at certain things he likes. He's starting businesses or coming in very early on businesses and informing the product design and the technical requirements around certain products in those businesses to then operate them in such a way that they dominate the space that they play in. SpaceX is being probably the best example of this, where he was able to more or less privately fund himself a rocket ship company, which is unheard of and probably won't happen again. There have been plenty of billionaires who have tried this, like Jeff Bezos, or one of the, I think Bill Gates even, or one of the Microsoft guys, Paul Allen, I think, also tried to, I mean, Richard Branson also tried to do this, but they're unsuccessful because they were just lucky businessmen in the sense that they pursued just one opportunity but had quite good business brains. Elon's got quite a good technical brain that he applies to his also good business brain in a way that allows a synergy. Now, the synergy here is exemplified by the types of businesses that he's been able to both generate and then operate. So Tesla is now, I think, if not the biggest car company in the world, and then also only selling one type, electric vehicles, rather than mass producing combustion vehicles. And then you can also point towards PayPal, and he had, I think it was X Payments or something like that was the precursor to PayPal, which he started with, which was merged with Peter Thiel's and Reid Hoffman's companies into PayPal, which was then sold. So having the ability to be a technical force in payments, in cars, and then in rocketry, not even mentioning the other stuff, is what we call remarkable, and we would admire a man if he wasn't so controversial in some other ways. And now obviously he's being able to buy Twitter and X, and that has important ramifications from his social and political standpoint. We won't get into that. Anyway, the purpose of this one is to educate you first on why capitalism and how we can think about entrepreneurs as men of greatness, but then also going and me saying to you, and this could be the part 2 of the video, is to say, like, if you want to be a businessman, if you have the aptitude, the acumen, and you have the intelligence and the, you might call it ocean score, but the conscientiousness and the energy level to go, yes, I want to create something, yes, I want to be a successful business person, it is possible, and I can show you how. I won't necessarily be able to tell you what product you should make. If you have technical skills, that obviously definitely helps, and if you can computer program, or you can design, you can manufacture things, then that's a massive boon. But once again, I'll just explain to you how the market accepts new businesses and how it uses capital to propel those businesses, and what the financial instruments that are available to you should you be at different stages of business creation. This is not some like online course, and you won't have to pay money like you would to some other YouTube guys, but I'll give you this for free, because if you've gotten this far in the video, you've earned something for sure. Yeah, so once again, I don't want to encourage a materialist philosophy. This isn't about I want all the money in the world, and you can see this with successful entrepreneurs where they post their pictures of Ferraris and Lambos and Andrew Tate style videos of look at me on a yacht banging all these hot girls. This is to say that it's a very spiritual motivation around growing an idea from a spawning it and then also seeing it mature and then reaping the rewards from that. And that can be spiritual, it can obviously be monetary, and I think from a status point of view there's also some element there. We would start by saying you need to create a product or service. The particularly fond for the market services are technical services in the information technology space, so particularly software. It can also be hardware. It's quite hard to do hardware if you're not starting NVIDIA 30 years ago. There is a timeline aspect to creating hardware. If you're creating new hardware for things that aren't developed yet, it's even harder. So rather than just trying to perfect something that exists, you're actually generating something almost new and inventive. Very difficult, can be very rewarding, both personally but also from a business perspective. But software in general is this golden goose, where people like software because of its ability to be designed and iterated quite fast. So you can come up with an MVP, which is a minimum viable product, within say 3 months or 6 months, which you can then try to implement and sell to customers. You can also fix it quite easily online. You obviously make a new version of it, and then you've fixed bugs, you've been able to improve features, etc., expand. But then also the way that you go to market, which is a super important part about software, is to say it's attractive from the business model, but also expansion. So the business model is attractive because you offer software on a recurring basis annually. So you say, I'll charge you $100 a year for ever, basically, and the software will get better every year, and obviously you'll be happy, and then you'll never leave. And you'll say, okay, well that's only $100, but for cash flow purposes, we can then at least account for the likelihood to keep $100 every year. And if the cost to deliver the software in the first year is $150, and then only $10 every consecutive year thereafter, you go from losing $50 the first year to then making $90, and that could be potentially $90 forever. So you can kind of understand the snowballing effect of having many customers, and particularly business customers, so SMEs, but also large enterprise customers, purchasing software from you. And this can be very evident in business like Salesforce, which offers a CRM, a customer relationship management tool, where they have large contracts which go on forever, and there will be additional opportunities to sell you more of their features and the different types of their products. But in general, it's a really easy way to understand why account management in the software industry is very important, because if you can secure a customer early, then you can count on their cash basically being given to you. And sometimes you can even make them pay up front and then amortize the cash across the year. So from a cash flow perspective, you get the money on day one, potentially. You get your $100 now, then you pay yourself the $8.25 every year, whatever it is, every month, until it's zero at the end of the year, and then they have to start paying again, right? But the idea is that you will then have a business model which is sustainable from a cash perspective, which is very hard to do if you're starting a business which is not cash generating until you've sold products, particularly transaction products. So say I'm selling you sunglasses that I make in my basement. I can't sell the first pair until I've made them, and that might take me having to buy a lot of equipment to make. So it's called capex, but capital expenditure, to buy all this equipment to make glasses. And then only then can I sell the glasses for money, but I have to recoup first the entire time spent, and as well as the materials, and as well as the equipment I've outlaid, plus other expenses around hiring lawyers and establishing my holding company, and then also paying my staff or myself. So you can see how the negativity around cash flow up front on a business that's not software related is much higher. Hence why you get so many guys starting their software businesses. There's a lot of elements to why it's just much more beneficial from a creative standpoint. And this is where you'll start to see venture capital funds. So at the very early stages, you have angel investing. Angel investing is just another way of saying mum and dad, or my cousin, or a businessman I know who has a bit of cash, and they'll throw $150 at you for this company and say, look, here's your first year and a half of costs, or your first year of costs, sorry, but I want 25% of the business or 10% or whatever, and then you'll have to disagree and agree. And if you've got co-founders, they'll have percentages. You'll have this percentage pie chart mapped out on what's called a cap table, capitalization table, where you have who owns how much percentage. And if it's all one share class, then you all own the same voting rights and all the other rights that come along with this. Now, there's a lot of rights to shares. You can have liquidity preferences, which means different share classes will have different return profiles. So if you've sold the business, you could potentially get less money or more money than someone else. You can also have different sort of mechanisms around what happens in terms of board seats or different events that might happen to the company, like if it goes bankrupt, or you need to borrow debt, or if you want to dilute other shareholders, or if you have incentive programs that are going to dilute everyone else, etc. Anyway, this is where angels come in, and then seed vesting comes in around this time that you've got the product ready and going to market with it. So if you've got a product, you've developed this in 6 months, it's cost you all the money, and you go, okay, now I actually need money to start selling it. I need to hire one salesperson, and I need for them to be able to be supported, and we need better computers because we don't have any, in an office space because we've been in my parents' garage. Then seed will come in and they'll give you maybe $200, $300. They'll give you more money than the angels, which indicates that the business is now worth more. So it's called an up round. And then also they'll have expectations around how you sell that, so how you spend that money. This means you'll have to have kind of what is a business plan around, okay, if they're asking for $200 now, it's because I have to spend 50 on salespeople, 50 on equipment, 50 on paying myself now, I can actually have a salary, and then 50 on miscellaneous, and that should get us through to next year. So you'll have a runway for this $200 cash, and it might be 2 years or 1.5 years. You'll go through this cash quite fast, usually, but that's kind of the nature of these businesses, is they're cash burning, but the idea is that you can grow fast enough to warrant the cash deterioration and then going to market, but re-fundraising. So you'll fundraise again, and this is when you start to run into something called a series. So Series A, Series B, Series C, these are just the notions of how early stage your company is, and typically how much it's worth and how much money you're asking for. And then each stage has very, well, yeah, they're very, I guess, diffuse and not necessarily clear purposes. But Series A typically is when you've established your business in a market and you're earning a substantial amount of revenue, which is not quite paying profits, but you're at least taking a gross margin, and a gross margin is just a financial way of saying your revenue minus the costs of selling the goods or the software or the service is positive, so that you're still taking home, after you've accounted for costs of not administrative costs and operational costs, but the service costs, that you're making money. And so there's some financial understanding that you will be required to comprehend if you want to go into that, because while the series fundraising can be nebulous around what it's for, typically the understanding of your financials should be very certain and say, I know I'm selling 1 unit of Y for $100 every year, and I need to sell 300 of these services to 300 customers by next year if I want it to be profitable, but this is going to require me to spend X money on salespeople because I know each salesperson can sell X amount in this many months. So you can more or less provide projections and forecasts. They'll never be right, but this is just at least indicative that you've started to think about the growth of the business analytically. There will always be misalignment with what people expect and what people presume around what's possible. It's always in your best interest to be as aggressive as possible here, because you want the best return on the lowest amount of money. So you want a venture capital firm to give you $100 million, but you don't want to have to give up as much. Well, you want to resist giving as much ownership as possible, because you know you'll be diluted several times later down. This is why you can see someone like Jeff Bezos only owns 12% of Amazon or 11%, is because you get diluted along so many different levels across the journey, that your ownership and your position of being a founder is itself diluted by venture capital firms, growth equity firms, and private equity firms before you've IPO'd, which then gets diluted by the public market, usually by large institutional investors and then other public investors. Sorry. Anyway, this is why venture capitalists typically go for software. It's typically why software is attractive, because of the way it scales, because of the way contracts work, and because of the way the interaction of spending money to return money is fairly one-to-one, and particularly when there's something called unit economics, but every type of analyses can be done on the lifetime value of a customer and how much a customer is costing to acquire. So CAC and LTV, these are very, very generic, but they're really useful in understanding exactly how that happens. When we think of private equity, I think we instinctively say something moralistic like evil or corrupt or nepotistic, it's cronyism, etc. And this can be very true for third world countries where private equity is just really old families owning and running all these businesses in very corrupt ways. But in the first world, in the West, private equity just indicates that it's not a public entity that's providing capital. We'll go back to this capitalism thing. In the 80s and 90s, there was a lot of asset stripping. So there are horror stories from many public businesses being sold, and public in this sense being state-owned, businesses being sold to private equity firms who would then strip the assets that were profitable out, sell them all, fire all these people, particularly government employees, previously government employees, and just fire them all with no means for reparation or redress. So this is why private equity has quite a negative connotations when you say it out loud, is because a lot of these guys in the 80s and 90s, and these firms are called like KKR or Blackstone or Apollo, and Mitt Romney, who was a presidential candidate, worked for Apollo. No, he worked for Bain Capital. Bain Capital as well being a spin out of the consulting company, which is also notorious. These big private equity firms were, at their inception and the beginning stages of their life cycles, very, you might call corrupt, but definitely a negative ethical attitude towards the common man, and so that they would go in and asset strip with impunity. They would fire and rank and yank. They would do all of these quite ignoble business practices, and you can attribute that to the founders, who are now very wealthy billionaires, and that they all say, well, I was successful regardless of the ethics of it. But nowadays it's much more commoditized in the sense that you can't go in and just do that anymore, because any easy win has been done. So all this asset stripping and these easy turnaround businesses, well, all you had to do was provide a bit of capital and borrow heavily against the cash flows to then turn an 8x or a 9x profit, are basically gone. So there's so much competing capital now for assets that there's a lot of times you're overpaying for assets, and there's a lot of work to be done on growing the asset and not necessarily having it be this easy. I buy something, it's 16 months, I flip it for 5 times my money because look at all these dumb family owners, and they didn't understand how capital can influence the value of a business, particularly debt. Anyway, the current, and I will just maybe finish this tangent by saying the current evil in the market is probably around hedge fund guys, because the way that hedge funds operate in this sphere of the market, which is about inefficiencies of market, but they're to create zero value. They're basically about arbitrage opportunities on, we think this can be undervalued for the next X months, so then I will buy it now and then try and manipulate the market. So Bill Ackman is one of the most noted, but there's Carl Icahn, there's a lot of these hedge fund guys who will go on TV and start bad mouthing, and they call themselves activist investors, but really they're just trying to manipulate markets into providing them higher and higher returns. This can be seen in the Game debacle. So Game was a company which, sorry about the light, I had to change the light. Game was a company which basically sold video games, and then it has had a lot of media attention around its debt situation and how it was valued and not valued for different reasons. But anyway, this is why hedge fund guys are probably, when you want to point towards evil capitalists, they're the embodiment of this sort of ethical negativity, or you definitely might call them unscrupulous men, and so that's why I think. If you are going to be viewing capitalism unfavorably, particularly with a moral prism, then it should be directed probably towards hedge fund guys who are notoriously not value creators at all. There is a rare instance that maybe you'll find one or two activist investors who genuinely want to improve a business, but more or less they're looking for easy money as fast as possible. Which is to say, the nobility in success is only when there is sweat-born input, and that the way that we view businessmen and how they feel about themselves as noble in success varies, but most often is around how hard they've worked to create value, and how we would see them as men who would do it even if the monetary reward was not there. So you love and work hard enough at a business that it doesn't matter if there is a financial return that making you a billionaire, or it's only enough to put food on the table. Well, you would still do it because there's this love for the game almost, and that's why someone like Elon, who could have retired 15-20 years ago with his tens or hundreds of millions of dollars, is seen as this exceptional spirit, as well as Peter Thiel, and there's some other businessmen, and they're obviously very controversial figures for their political and social interactions, but as businessmen in general, I think we have to respect them a lot because of the admirable qualities around continuing to try and innovate and grow businesses in environments where there's no intrinsic need from a monetary perspective that now I need to be a billionaire, now I need to be a 100 billionaire, or whatever it would be. They've also gotten by using business tactics which are more socially acceptable. There's not as much cronyism and nepotism in these tech companies as there are in a lot of other businesses, where you'll be appointed proprietor or director or something like that of a family business, or you'll have, particularly like I say in third world countries, where it's a lot more secreted around who's allowed to do what and the privileges of that. One thing is using your network and your parents' network to offer opportunities. Like Bill Gates, obviously his parents were, or his mother was on the board of IBM, and his interactions with large contracts is obviously notorious for how Microsoft gets started. But it is another thing to say, starting a business with some beneficial contacts doesn't turn you into Microsoft, which is the monopoly of software and business enterprise software in the world. So I think there's definitely still something to be said with what it takes and is required from a Faustian will perspective to garner that level of success. Spengler himself advocates that you do business or engineering or being an inventor, something that's real, and being a man of fact, not sitting there doing nothing, but also not sitting there being a philosopher, being an intellectual, being an academic. These are all very useless ways to spend your time, and useless in the sense that truly you will regret having done that, and there is no level of cope possible in the world to have a man who's 65 spend the youth and the energy and the strength that he had in his 20s, 30s and 40s and 50s even, in a way that led to nothing. To say like, oh yeah, but I was a professor of economics at Chicago for 20 years, look at me. It's embarrassing. I mean, it's an effrontery to what it means to be a man. You may as well be a brain in a jar connected to a chatbot. I mean, there's no significance to that. And then they'll award each other prizes, like a pseudo Nobel Prize in economics, or the I don't know, some peace awards and all these sort of non-useful accolades, but they're all meaningless. We know they didn't earn them, and we know that no one else cares. They have to all care about it themselves, otherwise the entire fallacious house of cards falls down, right? So this is to say, you're better off employing your will in such a way that it's a resounding through the ages of who you were, and that's Andrew Carnegie, and if that's Henry Ford, and if that's Vanderbilt. It's done in a way in business that can still be meaningful to your saga. And maybe my walkthrough of how you create a business hasn't been perfect, but it is to show you how capital interacts with your business, and that you can go out to anybody in the venture capital realm, if you've got a business which sells a product, particularly software, and you just email and say, hi, I have this business, this is our financial situation, are you interested in investing? And you can get a meeting. These people are not gods of technology. They don't understand everything about all your products and marketing from what they've seen, but you can go reach out to them and have a conversation. They may well write you a check for X amount of money. And this is just how business gets done nowadays, in this Faustian concept of organizational capital, and that we are trying to make the most efficient market-produced success ever encapsulated globally in the history of man. So I think there's a certain sense of grand romanticism to how the modern capital formation has flourished in that way. I'm happy to follow up, and if you have some questions, do leave them below in the comments.